There's a silent predator lurking in the world of retirement savings, and it's got its sights set on anyone who contributed to an IRA back in the 80s or 90s. This isn't about the stock market and it isn't some newfangled scam. No, this all boils down to a single, often forgotten IRS form, and if it's missing from your records, you could be forced to pay income tax twice on the very same money. Now, with a brand new senior deduction coming in 2025, this old paperwork problem has suddenly become a massive, urgent financial threat. So today, we're going to put on our detective hats and conduct a forensic audit of your IRA to find and disarm this tax bomb before it goes off.
And that quote right there, that is the absolute heart of the issue. You see, when it comes to your retirement accounts, the IRS basically works on a guilty until proven innocent system. The burden of proof is 100% on you, the taxpayer, to prove that you already paid tax on some of that money. If you can't find the records, and let's be honest, we're talking about paperwork that could be decades old, the IRS just shrugs and assumes every single dollar you withdraw is brand new, taxable income.
And this is what creates the double tax nightmare. Just think it through for a second. You worked hard, you earned a salary, you paid your income taxes on it, and then you did the responsible thing and saved some of that after-tax money in an IRA. Fast forward to retirement, you go to withdraw that exact same money, and the IRS shows up with its handout wanting to tax it all over again. It's your money. You already paid tax on it. But without the right form, you're on the hook to pay twice.
So how in the world did we get here? Well, let's hop in the time machine. Before 1986, things were pretty simple. You put money in an IRA, you got a tax deduction. Easy. But as you can see on this timeline, the Tax Reform Act of 1986 completely changed the game. It started limiting that deduction for folks with higher incomes, but it still let them contribute. And just like that, a whole new category of money was born: non-deductible after-tax contributions. That's the moment the seed for this whole problem was planted. The official IRS name for this pile of after-tax money you've put in is your basis. Just think of your basis as your own money that you're just storing inside your IRA. Since you've already paid taxes on it once, it should, by all logic, come back to you completely tax-free. And it can, but only if you have the receipts to prove it. To really get how the IRS views an IRA that has both pre-tax and after-tax money mixed together, tax pros came up with a fantastic analogy. They call it the cream in the coffee rule. It's a really simple way to wrap your head around a pretty confusing regulation, so let's pour ourselves a cup.
Okay, so imagine your entire IRA balance is a big cup of coffee. All the money that's never been taxed, that's your pre-tax contributions and all the growth over the years. That's the black coffee. Your basis, that after-tax money we were just talking about, that's the cream.
Now, here's the absolute kicker. Once you pour that cream into the coffee, it's mixed in for good. You can't just dip a spoon in there and scoop out only the cream. So every single withdrawal you make is considered a blend of both the taxable coffee and the tax-free cream. You can't just tell the IRS, hey, this withdrawal, I just want the tax-free part, please. It just doesn't work that way.
Now, that's the fun analogy, but you know the IRS has a much more official-sounding name for it. It's called the Pro-Rata Rule. Pro-rata is just a fancy way of saying in proportion. It's the exact math formula the IRS uses to figure out how much of your withdrawal is taxable coffee and how much is your tax-free cream.
And just to make it a little more complicated, the IRS makes that coffee cup even bigger with something called the Aggregation Rule. What this means is they don't care if you have 5 different traditional IRAs at 5 different places. For this math, the IRS pretends all your traditional SEP and simple IRAs are just one giant account. The good news, as you can see, is that your Roth IRAs and your 401ks are kept totally separate. They don't get mixed.
Okay, let's look at some simple numbers so this makes sense. Let's say all your IRAs together are worth $100,000. And you've done your homework, you've found the proof, and you know you have $20,000 of after-tax basis. That's your cream. So that means your entire IRA coffee cup is 20% cream, or 20% tax-free. Now let's say you decide to withdraw $10,000. Well, the pro-rata rule says 20% of that, or $2,000, is your tax-free cream. The other 80%, a full $8,000, is considered taxable income for the.
Now, you might be sitting there thinking, okay, that's annoying, but I guess I can live with it. And for a long time, you might have been right. But a brand new law has completely changed the equation. Getting this wrong is no longer just a little headache. It's a major financial threat, especially for the next couple of tax years. This number, $6,000, this is the number that changes everything. It represents a brand new tax break designed specifically for seniors. And believe me, you do not want to accidentally miss out on it. So the One Big Beautiful Bill Act, or OBBA, created a powerful new senior deduction that kicks in for the 2025 tax year.
We're talking a $6,000 deduction for single filers 65 and over, and a whopping $12,000 for married couples. But, and you knew there'd be a but, right? Here is the critical catch. This amazing deduction starts to disappear if your income goes over $75,000.
And this is where the trap snaps shut. Let's go back to our example. If that $8,000 in taxable coffee gets added to your other income of, say, $70,000, you're at $78,000. But what if you lost your records? Then, the IRS treats the entire $10,000 withdrawal as taxable. That untracked basis creates phantom income, money that looks like new income on paper but isn't. And boom, just like that, your income jumps and pushes you right over that $75,000 cliff.
And that right there is the double whammy. It's a brutal 1-2 punch to your retirement funds. First, you get slapped with income tax on money that should have been tax-free. Then, as an encore, that fake phantom income disqualifies you from the $6,000 deduction you should have received. You're losing money on both sides of the equation, all from a simple paperwork mistake from years ago.
Okay, so that's the problem. It's a big one. But the good news is you are not helpless here. You can absolutely take control of this situation. And it all starts by doing a little forensic audit on your own tax documents.
All right, here's your action plan. First, go find a copy of the last tax return you filed. Second, flip through it and look for IRS Form 8606. This is the form that tracks your cream. The most important spot on that form is line 14. This line is supposed to show the grand total of your basis from all the years before. If you know for a fact you made non-deductible contributions and that line is blank or says 0, that is a major red flag. It means your basis is not being tracked.
So what happens if you do your little audit and discover that, yep, you've definitely got a cream in the coffee situation? You've got this mix of funds and you want to get to your tax-free money without the pro-rata rule messing everything up and costing you that OBBA deduction. Is there any way to unmix the coffee?
Yes. Amazingly, there is. It's a strategy called basis isolation. Remember how we said that 401ks are kept separate from that big coffee cup? Well, that's the secret. If you have a 401k from a current or even a past employer that accepts rollovers, you can move all of the pre-tax money, all the coffee, from your IRAs into that 401k. What's left behind in your traditional IRA? Nothing but the pure after-tax cream. And from that day forward, every dollar you take out of that IRA is 100% tax-free.
Now, I know what a lot of you are probably thinking. You've got to be kidding me. I made those contributions 30 years ago. That paperwork is long gone. Don't panic. Even if you don't have a pristine file of every Form 8606 you ever filed, you can reconstruct your basis. It's going to take some detective work, I won't lie, but it is possible. You'll need to dig up any evidence you can find. Old tax returns, old brokerage statements, maybe a form called a 5498. You can even ask the IRS directly for your old wage and income transcripts to help you piece that puzzle back together.
So at the end of the day, it really all comes down to this one critical question you need to ask yourself. Is your IRA basis phantom, just a forgotten number that's about to cause a huge tax headache? Or is it properly documented on Form 8606, ready to protect your money from being taxed twice and ensuring you get every deduction you deserve? The answer could be worth thousands of dollars. It's time to check your records.